Hello ladies and gentlemen, and welcome back to another episode of Investing for the Common Man, the channel that helps you save both your time and your money with short, concise, instructional videos. Today I'm back with another super quick breakdown in 2 minutes or less of the option Greek Vega. If you like these shorter videos that don't make you waste your time digging for that specific nugget of information you were looking for, please let me know by hitting that like button. The last important Greek variable for option traders is Vega. Vega deals specifically with changes in implied volatility. If you've been following my video series on options, you already know that high implied volatility inflates option values because many traders and hedge fund managers use options as insurance or a hedge against risk. But what if an unexpected event happens in the market after we purchase our option that causes implied volatility to spike? Vega represents the amount by which the option value will fluctuate in response to a 1% change in implied volatility. So an option with a Vega of 0.03 will increase in value by 3 cents if implied volatility increases by 1%. This may seem like a relatively small move, but implied volatility can move by several percentage points at a time in response to any high volatility market event. To give you a better idea of this, let's take a quick look at a commonly occurring circumstance that causes violent changes in implied volatility. One of the most common market events that causes increased levels of implied volatility is when companies report earnings. These events are always scheduled well in advance, so the market eagerly awaits the reports that could possibly launch a stock into the stratosphere or send it tumbling. These possibilities get priced into option contracts with increases in implied volatility. Let's take Nvidia for example. We can see that the company is scheduled to report earnings on August 19th. On the options chain, we see that the contracts that expire on August 21st, right after the report, had the highest implied volatility, almost 12 percentage points higher than the previous week. After the high volatility event passes, you can expect implied volatility to drop back down to normal levels. In this case, if you bought an at-the-money call with a Vega of 0.34, then you should multiply Vega by the approximate 12% drop in implied volatility to get an idea of how much value your option will lose after earnings. In this case, that would be $4.08 per share. That's more than $400 that you would lose to implied volatility. The stock would have to gain more than $4 after earnings to make this trade profitable, and that's not even factoring in losses to theta decay that we talked about in my last video. This is why it's very important to design your option strategies with implied volatility and Vega in mind. It is possible to design a strategy in this sort of situation that changes in implied volatility will actually work for you, increasing your profits instead of against you. And that's it. That's really all you need to know to start using Vega like a pro. For more short and sweet instructional videos like this one, please take a moment to like this video and subscribe to my channel. If implied volatility is a new concept to you, I have an in-depth introductory video on volatility on my channel for you to check out. Let me know in the comments below if you have any questions. Until next time, keep calm, stay healthy, and happy trading.